Hello, welcome to our third series of Fieldman Fundamentals. My name is Jason Chung, Vice President with Fieldman Rolapp Associates. Fieldman Rolapp has been a municipal advisor for 55 years, serving public agencies with their financing needs. In this video, I am very excited to provide an introductory overview of general obligation bonds, what they are, what secures them, and how it relates to you as an issuer and also as a taxpayer. So general obligation bonds are voter-approved debt instruments which are secured by the collection of ad valorem property taxes. These taxes are levied on all taxable property within the school district or community college district's boundaries. Taxable property includes residential properties like a single-family home, a condo, mobile home, or a multifamily unit. It also includes non-residential properties such as commercial, industrial, and recreational properties and businesses. Things that are typically considered tax-exempt property and not subject to an ad valorem tax are religious buildings, charities, and certain hospital and government-related buildings. So ad valorem is Latin for according to value, which means that this form of property tax is based on the assessed value, or what is called AV, of a property, and not the current market value. So if you purchased a home in the year 2015, which resulted in a change of ownership, your general obligation bond tax in 2021 would be based on the old 2015 market value, compounded by a maximum increase of 2% each year due to Proposition 13. It would not be based on your home's current 2021 market value that you might see on Zillow or Redfin, which is good for taxpayers since that would otherwise result in a higher tax each year. General obligation bonds also provide a promise to the bondholder that the ad valorem taxes shall be levied in an unlimited amount as necessary to pay debt service. This provides the greatest security to an investor, and as a result, general obligation bonds typically price at the lowest interest rates compared to other municipal credits. Lastly, general obligation bonds can also be issued by states, counties, cities, and towns as well. But this presentation will focus primarily on the K-12 and community college sector. The main difference between these two groups is that only school districts and community colleges can pass bond measures with a lower required voter threshold of 55% compared to the traditional 2/3 voter requirement. So prior to the year 2000, the traditional way to pass a voter-approved bond measure was a 2/3 voter approval requirement known as Prop 46. With Prop 46, districts need to establish a separate account for bond proceeds and also prepare an annual report which details the spend down of proceeds and the status of projects. However, under a Prop 46 measure, districts are not restricted by a maximum tax rate and are not required to provide a specific project list, though bond proceeds may be only used for the acquisition or improvement of real property. Under a Prop 39 bond measure, which is easier to pass with only a 55% voter approval requirement, there are some additional restrictions and requirements to consider. Similar to Prop 46, there is still the separate account and annual report that is required, but with a Prop 39 measure, the district must also provide a specific project list that is eligible to be funded. Additionally, a Prop 39 bond also requires the creation of a Citizens Oversight Committee to be formed within 60 days of the governing board declaring the results of the election. And this COC, or Citizens Oversight Committee, is tasked with reviewing the annual performance and financial audits of the bond program. However, even with these additional requirements, the vast majority of school and college district bond measures are of the Prop 39 variety due to the lower required voter threshold. Lastly, one of the main features of a Prop 39 bond are the tax rate restrictions imposed on school districts and community colleges. For all non-unified school districts, and this encompasses elementary, union, and high school districts, the maximum allowed tax rate that can be projected at time of bond sale is $30 per 100,000 of assessed value. For a unified district, the maximum tax rate increases to $60 per 100,000. And for community college districts, this maximum tax rate cannot project to exceed $25 per 100,000 of assessed value. The word projected is very important here, as the actual tax rate can actually exceed these thresholds for a number of years if assessed value does not grow to expectations. Now, these figures are maximum rates per a single bond election, but the school or college district has flexibility to request any amount below these respective maximum rates as well. Finally, Prop 39 authorizations are additive in cost, meaning that a unified district, in theory, can have multiple Prop 39 authorizations outstanding that will cost taxpayers more than $60 per 100,000 of AV. So the best way to interpret this tax rate for a homeowner is to find your current assessed value. For example, if a home is assessed at $500,000, then a $60 tax rate would cost you $300 per year. And this is taking the 500,000 assessed value divided by 100,000 and multiplying that factor by $60. Alternatively, if you lived in an older home assessed at 200,000, the annual cost would only be $120 per year. So we've established that nearly all new GEO bond measures are Prop 39 bonds. So what are they allowed to finance? Some of the eligible uses include real property acquisition and improvement of facilities, furnishing and equipping of school facilities, construction and replacement, and also technology improvements. However, general obligation bonds cannot be used for teacher or administrator salaries as well as other school operating expenses. And again, with Prop 39, there must be a specific project list in order for it to be paid from bond proceeds later down the road. So now we're getting into how the ad valorem tax rate is calculated each year. In simple terms, this is done by dividing the upcoming year's principal and interest payments of all the general obligation bonds outstanding by the district's entire assessed value. And each year, both the debt service amount and the assessed value will change. So it is very common for the tax rate to fluctuate a bit each year. So what are some of the factors that make our numerator and denominator formula change? Number one is the assumed growth rate of assessed value. If a district issues bonds that has payments increasing by 3% each year, then it will require its assessed value to grow by at least 3% annually as well to keep its tax rate below its projection. Conversely, if assessed value fails to grow by 3% or even declines, which is what happened during the Great Recession, then it would cause the tax rate to increase by whatever amount needed to repay the debt service, even if it is above the maximum tax rate allowed. Number two is the number of years the tax is levied. Spreading out a bond repayment over 25 or 30 years will require a relatively low annual tax rate compared to a repayment term of 5 to 10 years, which would require a higher tax rate. Number three is the assumed interest rate on the bonds. The taxes that a district can lock in on pricing day could very well end up being higher or lower compared to their earlier projections, and this would have a direct impact on the annual debt service requirements each year. And finally, number four, the timing and amount of bond sales a district ultimately decides to go with will also change future tax rates, as assessed value will grow or decline over time. Slide 5 helps to compare 3 different scenarios of how ad valorem tax rates can fluctuate based on future assessed value changes. On the far left, we show XYZ district with an assessed value in year 1 at $12.5 billion. Prior to issuing bonds, the district projects its future assessed value growth to be consistent at 4% starting year 2 and every year thereafter. So accordingly, at the time of bond sale, the district will structure its debt service to increase by 4% annually as well. In the fourth column titled Tax Rate per 100,000, 4% growth, each year's tax rate through year 1 and 25 is maintained at the $30 rate as AV growth exactly matches the growth of the debt service. The next column shows a scenario of actual assessed value growing at 5% each year. Since the bonds are sold in year 1, interest rates are locked in and debt service payments are fixed and cannot be changed unless refinanced at a later time. However, since assessed value now grew by 5% each year and exceeded our expectations, each future year has a correspondingly lower tax rate charge as a benefit of the compounding growth. What used to cost a taxpayer $30 per 100,000 in year 1 would only cost them $23.84 per 100,000 in year 25. Lastly, the far right column shows a negative scenario of what could happen if the district overprojects its growth at time of bond sale. If assessed value grew at only 3% for 25 years, the tax rate would then increase from $30 per 100,000 in year 1 to almost $38 per 100,000 in year 25. Some viewers may also recall what happens to their tax rates during the Great Recession when assessed values plummeted by more than 10% for consecutive years. This is why we recommend to our clients to use conservative assumptions based on a long period of historical data in order to prevent those periods of high tax rates. This slide shows a traditional general obligation bond issuance schedule for a potential 2022 bond election. One thing to note is if you are a district official considering a future bond measure, is that you must reasonably expect to spend down at least 85% of the proceeds within 3 years of issuance. This requirement is enforced to prevent an issuer from over-issuing above what is needed for projects. Because of this, districts typically plan to spread out their bond sales every 2 to 3 years instead of issuing everything at once. The bar chart on the left shows how these different bond sales can be structured at different points in time, but fit well together in one piece. In this example, we show a unified school district levying at the maximum $60 tax rate limit in order to issue 4 separate series of bonds of $50 million each, totaling $200 million in total. Series A, the dark navy blue bars, are structured to cost taxpayers the full $60 tax rate in the first year. However, in year 2025, the navy blue bars fall dramatically to about $11 per 100,000, which can be done by structuring less principal amounts to mature in those years. The reason for this is because the district anticipates issuing its second Series B bonds in that same year, which is the orange color. Therefore, a combination of Series A and Series B bond payments are structured to cost no more than the $60 tax rate in years 2025 through 2027, while still allowing the district to receive $100 million in proceeds by year 2025. Now moving on to year 2028, the combined Series A and B bars total below $30 per 100,000, again to provide room for the third Series B bonds, which are the green bars. Lastly, in year 2031, the Series A, B, and C tax rates combined for only $43 per 100,000, leaving enough future ad valorem tax revenues for the district to issue its final 50 million Series D bonds, which are the light blue bars. The far right table shows the numerical tax rates for each series, totaling no more than $60 per 100,000 in any year. This phased bond approach also helps protect taxpayers from being locked in a high tax for an extended period of time. For example, if the district issues its Series A bonds in 2023 and assessed value declined by 20% in 2024, those future navy blue bars would be required to rise substantially above $11 per 100,000 to pay debt service. However, the district has the option to delay or reduce the amount of its future bond sales in order to eliminate or lower all future orange, green, and blue tax rate bars. This can prevent the community from paying more than it was led to believe at the time of election. General obligation bond authorizations also never expire, so if a district goes through a period of unfortunate assessed value declines, it can always access the bond amount at a later date when its values recover. It's also important to know that this slide is merely a projection for planning purposes and can be adjusted in countless ways to meet each district's specific funding needs. And that concludes this fundamental segment of K-14 general obligation bonds. I really appreciate your time and hope that this was helpful. If you are interested in getting more information, please don't hesitate to contact any of our registered municipal advisor consultants at Fieldman Rolapp Associates. Thanks and have a great day.